Good afternoon, everyone. Good afternoon. Welcome to today's professional lunch at the Foreign Correspondents Club of Japan. I'm Anthony Rowley, a former president, and it's my pleasure to moderate today's session and to introduce our speaker, who is Shang-Jin Wei, or perhaps I should say Wei Shang-Jin, the chief economist at the Asian Development Bank. Dr. Wei was born in China, but is a national of the United States. He assumed the post of chief economist at the ADB in August of this year, and before that he had a long and distinguished career in academia and in international finance and trade. I can't list all of his achievements, I'm afraid, but among other things, he served as director of the Cheif Institute of the International Business at Columbia University, director of the National Bureau of Economic Research's Working Group on the Chinese Economy, and as a research fellow at the Centre for Economic Policy Research in London. Dr. Wei was formerly an assistant director and chief of division at the IMF, where he led the fund's policy research and advised on issues of international trade, investment and globalization. He was also the IMF's chief of mission in Myanmar in 2004. Today he's going to talk to us about the growth outlook for Asia, emerging Asia in particular, and also about Asia's participation in so-called global value chains. The ADB just last week issued its latest Asian Development Outlook update for emerging Asia, in which the bank appeared, I think, to take a rather sanguine view of prospects. It forecasts that growth would remain at around 6% this year in emerging Asia, driven mainly by China and by India, and at a similar level in 2015. The report argued that most Asian countries have taken the prospect of monetary tightening in the United States in their stride, quotes unquotes, and that the dangers of another tapering tantrum of the kind we saw last year is unlikely or is small. But others, I think, including the Bank for International Settlements in Basel, the Institute of International Finance in Washington, the IMF, as well as the former president of the ADB, who is now governor of the Bank of Japan, Haruhiko Kuroda, appear to be rather less confident on this score of how successfully countries can adapt to monetary tightening. In fact, some think that the considerable market turmoil may be ahead, and even possibly a bond market bust. Perhaps Dr. Wei will treat us to some of his own insights on this score. So let me stop at that point. Let me remind you all, please, to switch off or put your cell phones on manner mode as a courtesy to the guest. And please join me in welcoming Dr. Wei.
Good afternoon. Thank you very much for coming to this luncheon. So it's my pleasure to discuss with you Asian Development Bank's recent assessment of the economic outlook for the region. And I will also discuss with you a special report we have produced on Asia's uneven participation in global value chains. Let me see, how do I? So our assessment, in terms of our assessment, we have 5 key main messages. Number one, we are projecting developing Asia's growth to be about 6.2% for this year and 6.4% for next year. And number two, we think the relatively strong fundamentals in developing Asia will offset the weaker than previously expected outlook in advanced countries. And number three, we're projecting a relatively moderate inflation for both this and next year for the region. And number four, we think if the normalization of U.S. monetary policy is on schedule, it's unlikely to create a major disturbance for Asia this time around. And number 5, under Asia's participation in regional and global value chains, we are concluding that while some sub-regions are major participants, other regions are lagging behind. There's still a lot of opportunities to be exploited. Let me give you some more details. So our forecast for developing Asia of a growth rate of 6.2% this year and 6.4% of next year will keep developing Asia to be the fastest growing region in the world, and I think this is likely to remain to be the case in the near term. And the broader context of this forecast, of course, is that developed countries as a whole are doing not as well, especially in Europe, but also in Japan. But in spite of that, domestic fundamentals in developing Asia, including reform momentums, are holding up better than previously projected. That helps to offset weaker external demand from high-income countries. Let me go to East Asia first. For East Asia, we are projecting a growth rate of 6.7% for this and next year. That's helped by our projection of China to be at 7.5% this year and 7.4% next year. We are aware that relative to the range of forecasts out there, we are on the more higher end. This is based on our projection that the government of PRC is likely to strengthen its stimulus package. Number 1. Number 2, I want to make sure to add 2 more remarks. Number 2, we do see clear downside risks to that forecast, including relatively weak numbers from August and September. But that is like we are just saying that the stimulus package is likely to offset this. And number 3, as important, perhaps even more important, is while we are forecasting a stimulus package, we are not necessarily advising that. In particular, we want to stress that in our judgment, at this stage of Chinese transition, carrying out necessary reforms, including many of the reforms the government had said they wanted to do, is more important than meeting the growth target. In other words, if Chinese growth rate turns out to be weaker, turns out to be below the growth target, we do not think that's a major problem and certainly not a cause for panic, as long as employment situation is healthy. Given the Chinese structural adjustment patterns, to keep the same kind of a healthy employment, you don't necessarily need the previous level of growth rate to do this. So therefore, as long as employment is okay, not meeting the growth target is not as big a deal in our assessment. Maybe I should add one more thing to it, which is that when we talk about reforms, we have in mind, in particular, reforms in China. We have in mind reforms in factor market. To the Chinese reform of the previous 3 decades have been very, very successful in making sure that product market, the competition is in place, state-owned firms become a smaller part of the economy, private sectors have a greater chance to flourish. Those are very, very important. They need to be kept and strengthened. But as important, China needs to move on to make the factor market also more market determined, including facilitating migration of workers from rural areas to urban areas and stay there, and changing the social safety net to be more productivity enhancing, making financial market to be more in line with market determination principle, in particular making both interest rate and exchange rates to be more market determined. These are very, very important. Even if one wants to organize a stimulus package, aside from, or maybe in addition to, instead of the more traditional way of doing this, which is to increase credit expansion, in our view, there are different ways of doing that, and perhaps a more useful way of organizing stimulus package could be focusing on a broad-based tax cut. A broad-based tax cut perhaps is more useful for the medium-term growth and short-term growth than credit expansion. Credit expansion give you some kick in the short term, but potentially at the expense of accumulating more risks in the financial sector over the medium term. The positive effect of a tax cut will be further enhanced if it's coupled with government's reform program to downsizing the role of government in the economy. So far, those things, government has said it wants to do in various incarnations. I would add something the government has not formally said it wants to do, which is that those effects will be further strengthened and solidified if it can be followed by not just downsizing the role of government in the economy, but also downsizing the size of government, civil service. They will really help to ensure a sustainable growth path for the country. Those kind of things should be considered both pro medium-term, long-term growth, but also has a short-term positive stimulus effect. So that's on China. India, our second largest developing member countries, our projection is 4.5% growth rate for this year and 6.3% for next year. So this projection is based on the assumption that government of India is able to carry out most of its reform it says it wants to do. Okay, now if you look at the contributing factors to growth, I said we expect the domestic fundamentals to be strong enough to offset the weaker demands coming from advanced countries. So here's a picture about China that help to illustrate that case. If you look at the contributing factors to Chinese growth in the last over the last few years, what we see is that the leading contributors to Chinese growth are relatively strong and expanding domestic consumption and relatively strong domestic investment. So the external factors, or net exports minus imports, play a relatively moderate role. In fact, in the first half of this year, it's a negative contributor, small negative contributor to growth. In the second half of the year, we had a big trade surplus last quarter. The sign may flip, but numerically will still be a relatively small contributor to growth. So there was a time when Chinese growth was very much foreign market dependent. It's much less so today, and that's one of the reasons why the weaker outlook in advanced countries is not projected to have very big impact on Chinese growth. For India, various surveys of business and households show uptick in confidence, and so the market is guessing that the new government is able to do what it wants to do. This is the left graph. The right graph looks at the stock indices. That Indian stock market is doing better than emerging Asia as a whole, which in turn is doing better than other emerging markets, reflecting current market expectation that somehow the government broadly will be able to carry out what it wants to do. ASEAN 5, meaning Indonesia, Malaysia, Philippines, Thailand, and Vietnam, collectively is projected to do not as well this year, so a growth rate falling to 4.8% relative to last year, before picking up to 5.6% this year. So the downgrade is primarily driven by Thailand. the picking up also partly has to do with the expectation that with the return of stability in the country, investment will recover as well. We are projecting relatively moderate inflation for the region due to a combination of supply and demand factors. On the supply side, one key supply factor that will affect the inflation outlook is commodity prices, and we are seeing that financial markets projecting right now the commodity prices are low and has been falling relative to the recent past, and the financial market appears to believe that this will continue into next year as well. So that helps the moderate inflation forecast for on the supply side. On the demand side, generally speaking, when economies are not growing as well relative to their potential, inflation tend not to be very high, and this is where we are now. Essentially, most economies are not doing that strongly relative to their own potential. So that would also help to moderate inflation a little bit. Current account is one of those macro variables that used to attract a lot of attention. So in particular, current account surpluses of some countries in this region used to be a major news item, but we are projecting a very moderate current account surplus for the region as a whole, both for this year and next year, about 2%. This statement applies to PRC as well. PRC's current account will be in surplus, but it looks pretty moderate. That's consistent with what we saw from early picture, that Chinese growth now is mostly driven by domestic factors rather than by international factors. There are clear risks to this set of projections, so let me mention a few. The biggest risk, in our view, is that our current forecast is based on the assumption that for many of our major economies, announced reforms will be broadly carried out as the government intended, as what the financial market appears to be projecting. Of course, that may not work out their way. Politics of the country or other factors could delay implementation of some of the reforms in our major member countries, and that in turn could affect growth forecast. For the largest developing member countries, PRC, current forecast factor in the likely scenario for real estate, shadow banking issues, and so on, but things could turn out to be much worse than currently projected, which of course could also in turn affect our outlook for the PRC. Our inflation forecast is based on the assumption that commodity prices will stay low, with the current look at the geopolitical risks. But that could also turn out to be not quite their way, that any major and surprising spike in commodity prices could in turn lead to revision of inflation forecast, or if number four, if advanced countries turn out to be even weaker, Europe in particular, that could affect those countries that have particular exposure to Europe. Finally, current projection for the region is based on the assumption that U.S. tapering, the end of a quantitative easing, will be on schedule, meaning it will be over by the end of this month. Interest rate in the U.S. might rise by some moderate amount sometime towards the middle of next year. So that's the basis for the current set of projections. There's always a possibility that perhaps U.S. interest rate will rise earlier and by a greater amount than currently projected. So I know my friend Professor Marty Feldstein has written recently that he thinks that will be the case, that he thinks perhaps inflation rate will turn out to be higher than currently projected in the U.S., will be higher than currently projected. This will in turn lead to a faster and bigger increase in U.S. interest rate than what current FOMC statements appears to suggest. If that happens, that presents there will become a risk factor for our forecast for Asia as well. Each time when we do the projection, we also would choose a topic that of importance to the medium-term growth for our region. And this time, we are looking at Asia's participation in global value chains. But one of the reasons why we want to do this is, given that different countries in the region have different exposure to different, so Western, to be more precise, Western Asia, for example, is comparatively more dependent on how Europe is doing. East Asia and Southeast Asia depends comparatively more on Japan and on US. Given that advanced countries are doing different things, the prospect seems to be different right now. This could affect different regions in Asia differently, and our understanding will be more, more refined, more nuanced, if we understand how countries' pattern of participating in global value chain also varies. Right? That's one reason why we want to look at global value chains. Global value chains, it's a term that's simply refer to the fact that now to produce anything, a podium, laptop, or your smartphones in your pocket or on your table, now involve stages of production taking place in different countries. This phenomenon is more so today than a few decades ago. Very few products nowadays only use components and inputs that are produced locally, right? So that you can have production chain that takes place within a country, fewer and fewer of them doing that. You can have production chain that takes place across country within Asia, or across different continents. Around the world, there are three clear centers of global value chains. In Asia, East Asia and Southeast Asia stand out as major participants in global value chains. West Asia and South Asia are much less participating much less. And in Asia, two countries are most important in the value chain interconnections. So Japan and PRC. So Japan, in most sectors, tend to be the supplier of upstream components and inputs, and China, in many sectors, tend to be the downstream assemblers of this. It's not. This statement is true on average, but not true for every single sector. So several sectors in China tend to be in the middle part of the stream, and China is making a major effort to try to move upstream. But that's the picture. In North America and Europe, the centers are U.S. and Germany very clearly. We see participation in global value chains to be helpful to countries, both output growth and employment growth, in very clear way. Japan's earthquake and tsunami also illustrates potential risk. They also remind people that if you have production, if you have value chains, if you have a key component coming from a foreign country, any major shock to their disruption to their country's production could become a disruption to your production. So that is a realistic risk. I remember in the U.S. I moved to New York just around the time of the tsunami in Japan. I want to buy Prius. You couldn't get Prius for about 6 months in the U.S. There's a shortage of this because some key components apparently affected this. And I learned there's a particular ingredient to the paint, pigment to the paint, globally was only produced in northern part of Japan. So that affects not just Japanese cars, but also affects U.S. cars, German, European cars. No one realizes until something is missing. So for a while, for a few months, you couldn't buy car of any model of particular color. So that turned out to be paint is not that important, but there could be other components which could be very, very crucial. So that kind of a thing reminded people that why global value chains improving your efficiency, lowering your overall production, but also make you potentially more vulnerable to shocks in very far places. So that's a realistic risk. So we look into that kind of a risk. Our assessment is that as of now, these turn out to be it's a real risk, and certainly important risk for some companies or some sectors. But overall, they don't seem to be quantitatively a very big risk. One. Two, to the extent this presents a risk, global value chain makes you vulnerable to over-dependence on single supply. This also creates opportunities. So some of our sub-regions here in Asia, so Cambodia, India, and so on, they are not part of, not very well integrated into global production chains yet. Concerns about those risks also provide potential opportunities. That now companies are more used to thinking, I want to have, even if most of my production takes place in China, for example, I want to have a China +1 strategy. I want to have China +2, +3 strategies to making sure that you don't overly depend on one particular country for production, particularly production of key components. So this can also imply opportunities for countries. We're looking to why East Asia, Southeast Asia are leaders as participants in global value chains, why some other regions, sub-regions in Asia are not doing as well. And we find that very intuitively, cost of doing business, broadly defined, matters. In particular, not just tariff rates. So countries with high tariff rates tend to do less well as a participant in global value chain. So for example, Uzbekistan, the average tariff rate is much higher than Singapore, Hong Kong, not surprising. But the point I guess I want to highlight is this, right? Given that now production can take place, can be segmented into different stages, and different stages can be in different countries. A given tariff level is more damaging now than it used to be, because since components come. Let's take the example of electronic components. So iPhone has hundreds of different components. Some of the components, the components of the inputs into the inputs were made in Korea, and they're passed on to China to the next stage of component, and that component gets sent to Taipei, China in ADB's legal term, and then become another component, so back to China to be another component. So those since the same production involving components crossing border multiple times, therefore the same tariff gets applied to multiple stages of production. So that, therefore, the same 10% tariff becomes a much bigger cost than when everything was produced locally. Right? So that's the idea. So therefore, same tariff now has a magnifying negative effect. And it's not just tariff. Company cares about overall cost. Therefore, terrible infrastructure, higher logistic cost, or non-tariff barriers, all of those things tend to increasingly creating disadvantage for countries in participating in global value chain if you have too high logistics cost. That's why those having adequate infrastructure becomes more and more important in the GVC world than without it. Understanding global value chain also has lots of provides additional insight into many things. Let me give you an example of bilateral balance. Right? So because the GDP counts value added over firm, that's what GDP is. Sum up value added from different firms. Trade does not do value added calculation. Trade counts raw value. So when goods get shipped back and forth, you double count, triple count, quadruple count. So trade, gross trade, and GDP are computed on very different bases. This implies the possibility when you look at a bilateral trade balance in value added term can be very different from bilateral trade balance in gross term. So in our calculation, for example, take the example of China, US, Japan bilateral trade. Chinese trade surplus against US in value added terms is about 40% smaller than in gross trade terms. So in other words, official data overstates the extent of the Chinese trade surplus. In comparison, Japanese trade surplus against US in value added term is 40% bigger. So let me give you an example of why that's the case, right? So for the very simple reason, let me go back to the smartphone example. So in other words, if you think about value-added terms, a big chunk of Japan's value-added end up in U.S. consumers' pockets, right? In the form of value of components going to iPhones. So these should be considered as Japan's value-added exports to the U.S. They don't show up in official data because the way Japanese value-added of their components go into U.S. market is by passing through China. So the value-added gets shipped to China, recorded as Japan's surplus, trade to China. Once it's assembled into the phone, all of them will be counted as part of China's gross exports to the U.S. In contrast, so in other words, a big part of Chinese gross exports to the U.S. Reflects value added coming from Japan, Korea, and other countries, right? So only a small part of it is Chinese value added. In contrast, when U.S. exports something to China, most of it, 97% of this, reflects U.S. Value added. U.S. does not use that much foreign value added in producing for producing goods that are exported to China. This kind of asymmetry gives you this discrepancy between bilateral trade balance in value-added terms versus bilateral trade balance in gross trade terms. So that's sort of a value-added angle help us to get a sharper, maybe different way of understanding international trade relationships. By the way, value-added term, I was talking to a Nikkei reporter early in the morning. Sometimes people ask me, what do you think of the competition between Japanese FDI and Chinese FDI in Vietnam, Myanmar, and so on. So, but my answer was, the rivalry and the competition is something that's mostly played up by media, maybe overplayed, because if you think about from global value chain viewpoint, there's more complementarity between Chinese and Japanese FDI than competition, right? So there may be some competition building up high-speed trains. Maybe both countries can do broadly similar things. But for most things, for every high-speed example, there will be 5 or 6 other examples in which, in fact, companies from Japan, companies from China are doing very different things, right? So Chinese company may be producing assembly refrigerators, but to assemble refrigerators, the most valuable, most expensive component is compressor. They buy compressor from a Japanese company. Therefore, the more Chinese company going to Vietnam, the more profitable it will be for Japanese company to go in there. You just going there by yourself and producing compressors will not make much sense. If then the compressor you have to ship your compressor for a long distance to a very far away country to assemble this, right? So if you have a next door a Chinese company that specializes in putting compressor and other inputs together to produce refrigerators, that make it more profitable for you to do that. Conversely, it's also true, the more Japanese companies going to Cambodia or Vietnam, the more profitable it will be for Chinese company to follow. So there's also a complementary story there. There will be a very natural angle to look at things. If you think about from a global value chain point of view, you realize that different countries, Japan, China in particular, tend to specialize in different nodes of the production. Let me perhaps just end here. So let me conclude our. I have said, I guess, 5 main messages. Number 1, developing Asia's growth is forecasted to be still pretty decent, above 6% for this year and next year, keeping the region to be the fastest growing region in the world. And number 2, we expect strong domestic fundamentals in developing Asia to be offsetting weaker than expected economic outlook from high-income countries. And number 3, we are projecting relatively moderate inflation rates for the region due to a combination of supply and demand factors. And number 4, normalization of U.S. monetary policy this time around is unlikely to create major disturbance to Asia due to the fact that there's less supplies now. I should also add precisely because Japan, Europe, and US are at different stages of business cycles right now. Also, the monetary policies are not synchronized this time. They also have a sort of a natural offsetting effect, at least partial offsetting. And finally, global value chains are very helpful to country in terms of employment growth and output growth. But Asia's participation in global value chains is very, very uneven. So East Asia, Southeast Asia stands out around the world as sort of leaders, as participants. But there are a lot of underexploited opportunities for South Asia and Central and West Asia. So let me stop here. I'm happy to take questions, comments, challenges. Thank you very much.
May I take my microphone? Of course. Okay, well, thank you very much. You certainly covered a lot of ground there. We'll open up the floor to questions now from the working press first. If I could just briefly ask you a question myself. Your point about value added is a very important one, I think. What are the implications of this for exchange rates? I mean, the yen has been depreciating quite rapidly, as you know, recently, and this would normally bring cries of protest from other countries in this region. But this time it's been relatively quiet. That may be because they're saying, well, Japan needs to get back on its feet, so we'll let the yen depreciate. Or it may be that the structural changes are now making changing the impact of exchange rates. Can you tell us a little bit about that?
Yes, indeed. This is down, right? Is it down? One of the important implications of global value chain angle for macroeconomics is indeed it could affect the way we understand the exchanges. When IMF computes real effective exchange rate, IMF looks at real effective exchange is meant to be a summary of a country's overall external competitiveness linked to exchange rate. It sort of weights bilateral exchange rates based on some set of weights. Typically, the weights will be proportional to trade. So you assign positive weights between 0 and 1 to different countries. Their way of computing exchange rate will not be quite right once you think about global value chain term. If, going back to Chinese electronics exports as example, right? If the trade relationship between China and Japan in the electronics sector is mostly in the form of Japan supplying components to China and China use it to buy those things, then in principle, the right conceptually correct exchange rate should assign negative weight to conceptually correct exchange rate for China should assign negative weight to Japan. Why? Because the depreciation of yen, in fact, is helpful to Chinese competitiveness. If your inputs become cheaper, so that kind of point currently is not reflected in the way IMF, BIS, U.S. Federal Reserve computes exchange rate. That's something that we want to we are developing framework to change that. And that perhaps is one of the reasons why you do not hear uniform opposition to exchange rate change. Of course, this picture varies from sector to sector, right? So electronics happen to be one in which picture is relatively clear because Japan just stay on very top of the upstream of the production chain. China stay relatively low end of the production chain. There are more complements than competition. In some other sectors, things could be a bit different.
Okay, well, questions from the floor, Martin.
Martin Körling from Germany, Handelsblatt. 2 questions. First question, I would like to ask your opinion about the political costs, the economical costs of the political or diplomatic difficulties here in East Asia between Japan, China, and South Korea. So how much growth basically is being lost potentially due to the political problems? And the second question is regarding South Korea. In South Korea, the growth is slowing. I talked to some economists and technology experts here in Japan. As they are afraid that South Korea, especially with the strengthening of the won against the yen and the rise of Chinese manufacturers in the value chain, basically, that South Korea will be squeezed in the near future and lose its competitiveness and will face a kind of Finnish phenomena because it's so dependent on a few big companies. So what is your reading of South Korea, the growth in South Korea, and the outlook for South Korea in the next 5 to 10 years? Where are the problems for that country?
Thank you. On the first question about the political tension among the three major Northeast Asian economies, my assessment, as of now, they have not amounted to a major economic cost, and that's because there's a difference between rhetorics and what's happening on the ground. These three economies actually trade a lot with each other, have a lot of investment. In particular, China is the largest trading partner for Korea. I believe it's for Japan as well. I'm not 100% sure on the second one, but the first one is. It is? Okay. And both Korea and Japan are one of the major trading partners, most important trading partners for China. There's a lot of trade and there are a lot of investment, especially from Korea and Japan to US to be well integrated production chains. In previous years, at least, whenever we see tension flaring up between China and Japan, you look at the trade data, you see relatively transitory effect that over a few years you don't really see there yet. This leads to the next statement, which is that there's always a possibility that if those things get worse, more persistent, this could be a problem. Right now, a lot of Japanese companies are talking about going elsewhere. Don't want to put all the eggs in the one Chinese basket. I think it's mostly not because of politics, mostly because of economics, precisely because of Chinese relative success in its growth. Chinese labor cost in local currency, in RMB, essentially has doubled in the last few years during a relatively short space of time. Once you take into account the fact that Chinese exchange rate is one of the very few, Chinese currency is one of the very few currency that has appreciated against US dollar by about 30% in the last few years. So Chinese labor cost in dollar term is even higher. Now you add to the fact that dollar has been appreciating against Japanese yen. So in yen term, of course, Chinese labor cost has shot up so much. That alone, I think, is the primary driver for companies to rethink about where to place their overseas production. Right? So they might cite non-economic reasons, but I think that might be the main driver. This basically means that we're going to see some changing composition of investment. You used to go to China to take advantage of cheap labor to assemble stuff. Nowadays, we know many other countries in Chinese neighborhood have even lower labor costs. India's labor cost is only 40% of China. Cambodia, Myanmar, maybe 1/6 or even lower. It's easier to find countries with even lower labor cost. Now, those countries have terrible logistics, so the advantage of labor cost is sometimes offset, sometimes more than offset by very high transport costs, terrible port system, and so on and so forth. But Asian Development Bank and China, Japan are helping those countries to improve their infrastructure. Perhaps at some point, the calculation will change this. It's worthwhile to go in there. But as China is moving upstream, trying to do less labor-intensive products, more skill and ID-based stuff, this also offer additional opportunity. This is linked to your second question about Korea. The impact of China's rise on Korea. So there may be in some sector, in short term, you might see some competition. in the long term, you realize production chain of most products tend to be very, very long, right? So China and Korea are still, in most sectors, are in very different stages, different stages of a value chain, with Korea and Japan clearly on top. So I think Korea still, if there's a competition, it competes more with Japan and Germany than with China. The relatively low cost part of a thing will not be competitive for Korea anyway. Without China, other country will get those production out of Korea's GDP anyway. So Korea has a lot of successful stories. So it's not just Samsung. Samsung obviously is a very prominent example, but Korea turned out to be very, very innovative. In fact, Korea is a clear model for China. If many countries are talk about special challenges facing middle income countries, and Chinese leadership likes talk about those kind of challenges. A clear path forward for China is, if China ever managed to move forward, it needs to be like next Korea, in some sense, right? So you want to be the next Korea. You don't want to be the next Argentina. That's sort of what divides the two futures for many middle-income countries. So I think that there are complementarities as well as a bit of competition, but complementarities still the main thing. Korea can continue to integrate itself with the regional production chain. Maybe it move even to the further upstream, and China will move to the middle stream, and they can all integrate better with countries like Cambodia, Myanmar, and so on. They will be at the lower end of the stream, and they will be to the benefits of all those countries. Thank you.
Okay, next question, please. If there isn't another immediate question, maybe I could just come back to the question of tapering or interest rate rises. How do you see the mechanics of this? I mean, interest rates are going to rise in the United States, almost certainly. They're going to rise in Britain. They won't rise in... Two questions. One is, then if I may, as the US is tightening and Britain is tightening, so Japan is continuing to ease, and so is the ECB. So are those two things compensatory in terms of total capital flows? In other words, everything remains more or less as it is. How interchangeable are they? And secondly, what are the mechanics by which rising interest rates in the States, and less so in Britain, will impact Asia?
Sorry, the second question.
Well, I mean, obviously money will flow back to the United States, so the US bond market and the equity market will benefit from that, but Asian bond markets, which are quite reliant now, especially Indonesia, on foreign investment, will presumably run into problems. I just wondered how you see the mechanics of this capital flow change working.
So when people talk about concerns with normalization of advanced country monetary policy, the kind of mechanism people have in mind is indeed this. Like, so if when interest rate goes back up in advanced countries, that tends to cause capital to flow out of emerging market back to high interest rate advanced countries, and this reversal of capital could be a source of disturbance. That is indeed the mechanism people have in mind. So now let's think about the two questions you raised, Anthony. First, different regions, different emerging markets have different relative dependence on capital coming from different source countries. Asia in particular, emerging Asia, the two primary sources of capital are Japan and US. Comparatively less dependence on Europe and perhaps UK. I mean, it could vary by country, but that's the broad picture. And therefore, in that context, given that US and Japanese monetary policy are not doing the same thing, they do the opposite thing, make it the shock of US interest rate change of a lesser shock to Asia than if both were moving in the same direction, right? So that's the one. Two, the way the composition of a capital flow also matters. Not all capital flows are the same. Countries that you look at their balance of payment structure, those countries, they use relatively foreign direct investment compared to portfolio investment or bank lending. So China would be an example of such a country, tend to stand up better in times of capital reversal, not just FDI, mostly because FDI is less volatile. Data clearly shows FDI is less volatile, but also your even when FDI gets reversed, the impact is very different from debt capital. Bank lending gets reversed. So when a firm finances itself by debt, broadly defined, it can be bond or can be borrowing from banks. They are both forms of debt, especially if they are denominated in foreign currency. You are very, very vulnerable because you're counting on, when this current debt is due, you're going to get new capital to refinance this. If the new financing stops, you can run into a bankruptcy problem. Not being able to pay in debt is technically what causes firm to go bankrupt. In contrast, if you have foreign direct investment, the reversal of FDI, having no new FDI coming, won't automatically trigger default. Even if a foreign firm want to leave, which data shows they don't really do as much as a bond investor, they have to sell the equity. That doesn't by itself trigger a default event. That's why countries that choose to either choose to or by accident happen to have more FDI related to hot money tend to stand up better to reverse over capital flows. Conversely, countries that use a lot of foreign bonds or borrowing from foreign banks, especially if those things are denominated in international currency, not in domestic currency, are comparatively more vulnerable to such things. So therefore, they need to do more to make sure domestic fundamentals are strong enough, foreign exchange reserve are decent enough.
So given the financing structure in these countries, which countries are most vulnerable?
Well, you look at data, you can clearly see some differences in the type of capital flows. China happens to use more FDI. Some other major countries tend to use less. We heard central bank governors of certain countries. First of all, I think it's a very encouraging sign. Demonstrate awareness of this and demonstrate determination to try to enhance the country's fundamentals so that when that event of reversal of capital flows actually take place, the country will not be caught off guard or will not be caught unaware at least.
Okay, very diplomatic answer, thank you. If there isn't any questions from the working press, would anyone else like to? Oh, Martin, you have another question, please.
Martin Kölling again. Another question that is on my mind, especially living here in Japan, is government debt, or not only government debt, but in other countries, maybe household debt or the debt of public corporations like in South Korea. In none of these two very important countries, the problems, the increase of debt has been stopped yet. Other countries are also financing economic packages by issuing new debt, and debt level is rising across the board. Isn't that basically a very dangerous path in the future? So when do you think that this debt issue might really start to hurt the economies?
Thank you. In many countries, both public sector and private sector have been accumulating debt for somewhat different reasons. For public sector, it's often is a result of attempt to offset, the impact of a global financial crisis. Weaker domestic demand somehow has to be corrected in some way. Debt is a fiscal instrument to try and to artificially create additional aggregate demand. Right? So that's the key reason why public sector debt has been going up. Sometimes also public sector debt goes up because government wants to bail out failing banks. The private sector's accumulation of debt, I think, is mostly driven by the fact that that the global interest rate has been low and been kept low for a long time, the last crisis become more and more distant memory in some countries. So people may be a bit tempted to accumulate more debt, low interest rate and debt. Both public and private sector debt is a risk factor to watch out for. That is important. I said earlier, but let me stress it again. Debt, especially those debt, when they are denominated in foreign currency, they carry special risks that country want to be aware of. So therefore, when the company have reason to choose, do I accumulate more debt or do I issue more equity? So they have their way of working out this. But from a country point of view, authorities need to worry about systemic risk. And systemic risk is very much linked to debt level, especially foreign currency denominated debt. Therefore, it will make sense whenever a country has an opportunity, it needs to somehow guide the use of funds towards the equity type of financing than debt form of financing. Number one. Number two, you want to also match those debt obligations, especially foreign currency debt, by precautionary tools like foreign exchange reserve holding, or swap agreements with countries with stronger foreign asset positions. Those things, countries in the region are doing some of those things, but it's important to keep in mind. It's always better when before a crisis arises, you have prudential regulatory tools, you have monetary policy tools structured in a way to minimize the chance of asset price bubble or other kind of debt, excessive debt accumulation, and so on. Then to wait for a crisis to happen. I think that's the lesson the last global crisis has taught us.
Okay, we have time for, I think, just one more question. All right, well, I'm going to ask you very quickly, about the Chinese property market. There are very different views on this. Some people think it's under control, basically. Others think that that's where the next crisis will occur. What do you think?
Chinese real estate market is a potential risk factor. So I want to say two things. One is the scale of the problem currently is not presenting a very big risk yet, and two, nonetheless, we shouldn't be too relaxed and should be vigilant against that kind of risk. So let me expand on the first one first. Why am I saying, as of now, it's not presenting a major risk? So Chinese real estate related loans, summing up all types of loans directly to real estate developers and loans in the form of mortgages to apartment owners, put together is about 15% of GDP. It's not a trivial amount, but it's not gigantic. Why? Because let's imagine a relatively bad scenario that 20% of the loans will go bust, they cannot be repaid. 20% of the bad real estate related loans means 3% of GDP. It's not a trivial amount, but ultimately, if this happens, this sort of a relatively bad scenario happens, then the question one wants to ask is, now that the real estate problem becomes a banking problem. Banking problem eventually becomes a fiscal problem. Can a country afford to bail out the banks and then move on? At the current scale, 3% of GDP. So imagine government adding 3% of GDP to its public sector debt is still relatively manageable issue. Chinese public sector debt as a share of GDP is much lower than Japan or US or most other OECD countries. In that sense, it's still manageable. On the other hand, of course, China started from a very low debt base, and it's growing very fast. Therefore, you cannot do nothing. You still want to be watched out for. You want to do many things to make sure the problem will be controlled, managed, and hopefully will be reversed. Otherwise, a few years from now, we will not be talking about the same numbers. So that's sort of the problem.
Oops. Sorry. Okay, so we can all go out and buy apartments in your hometown of Shanghai with quite comfortably. All right, well, thank you very much for coming and talking to us and covering an awful lot of ground. It's the first time you've been here, but we certainly hope it will not be the last time. And to encourage you to come again, I'd like to give you a 1-year honorary membership to the club. Thank you very much.
Thank you very much. I hope to use it to go to the library.
The library, yes.